Good morning and welcome, chart watchers, to the latest Stock Charts Outlook webinar. You've got Tom Bowley and Greg Schnell here today. We're going to share with you just a few items of interest, I think, with respect to some of the key indices and sectors and industry groups. How are you doing this morning, Greg?
Hey, I'm doing great. How are you?
I'm hanging in there. I mean, it's Saturday, and just finished a full week of the Market Watchers live shows. So I'm starting to feel like this is an everyday thing. I need a day off.
Yeah, you've been doing this. What's your Sunday gig? Yeah,
yeah, I don't have anything planned for Sunday. I'd like to keep it that way. We don't have another webinar, do we?
No, I don't think so.
What are you planning to go over today?
I've got a little slide here. Maybe I should just grab the screen and see if we can make that come up. I think the big thing I want to cover off today is there's some stuff going on outside the U.S. and I just want to bring it to people's attention more than worry about it. But there's some charts that started to crack this week in a big way, and I think it's pretty important to pay attention to those. So what I'm hoping to do is to cover those off and just make people aware of some of the things that started to happen. I don't know. Can you see my screen there?
Yes, we got it up.
Okay, good. So let's just enhance that a little bit. So I'm going to cover off some currency stuff because the US dollar and the yen and the euro are all at really tricky spots here. The commodity countries in general are breaking out, but Europe caught the flu, and HYG has a pretty scary signature on it. So I thought I'd go over that chart just to bring people up to speed. But we're starting to see some worries with weekly MACDs approaching the zero level on some of the charts. And so I just wanted to show those charts to make sure people were aware of, I'll call it, the tenuous situation in some of the areas of the market.
Sweet.
How about you?
Yeah, I'm going to go through. I've actually got a smorgasbord. We were putting the agenda together. I was kind of joking, but you probably could have just put smorgasbord under my name. It would have covered just about everything. I'm going to focus on the U.S., which is where I normally focus. And so I'm going to be looking at more specifically the S&P 500, taking a look at certain industries and some individual industry groups. And at the end, I'll go through some individual stocks, actually, that I really like and I'm watching, a couple of which I own, and I'll tell you which ones those are. And then look at some others that I think look really interesting, just waiting for better entry points. So literally, I got a bunch to go over, but the key theme is that we're in a bull market. And so just expect the rotation and try to take advantage of it.
Okay. I don't know if everybody can see this.
No, I'm not seeing anything right now.
Okay. That is a real problem for me. Tom, maybe I'll get you to take the screen and then I'll take it back. And it's just because I'm new to this technology. Sorry.
No, you're fine. It's Saturday, so we got time here.
So for some reason, my screen should show this, but it's not coming up. So
yeah, I got a pretty funny story while you're pulling all that up. I got a question the other day, and someone was saying, well, if you trade so much, how do you trade now that you're on the show 5 days a week? And it's kind of funny, but I actually had to put sometimes if a stock is close to a stop level, I'll put intraday stops in. I hate intraday stops because normally it just literally takes me out right at the bottom, and then my stock recovers. But anyway, I put in a stop on, I had Las Vegas Sands, and the stop that I put in, 67 was kind of a key support level. So if it had gone below 67, I probably would have just been watching it really closely. But since I was doing the show, I said, well, I'll just go ahead and put a stop in. And so I was going to type in 66.85, and I put in 66.86, and I just left it there. So I sent it in as a stop intraday, not a mental, but a physical stop. And I went through the seminar and came out, and Las Vegas Sands, I think, was like at 67.40, and during the show had gone down to 66.85. Stopped me out by a penny before turning back up. So it does make it a little bit tougher, and I hate putting in intraday stops. And after it happened, of course, I wasn't laughing at the time, but that's just one of the things. If you're and everybody, a lot of folks in here probably have that issue where you just got other things to do and you can't sit there and watch the market every minute. So anyhow, I thought it was funny. I chuckle now anyway.
Yeah. Okay. Well, do you want to do your charts first, or should I jump in?
If you're ready, go ahead. Doesn't matter to me.
Okay. I will try to see if I can manage my screen share a little better this time. It's still not showing where I want to see it. So I'm looking. Why is that not coming up? But I will keep hunting here. Okay, maybe that's what I need to do. Share screen and continue and go to my desktop. Share screen. Okay, excellent. Okay.
There you go.
Okay, so what we have here is HYG, and the reason I want to point this out is this is the high yield bond, and the one thing about the high yield bond is, normally it's been very bullish. If you follow me on Commodities Countdown, I've been showing this chart for a long time, and there's a real resistance level right here. I could turn on pinpoint. There's a real resistance level right here in around this 88 level, and we've struggled around it all year. But the big thing that happened this week was we broke the 40-week moving average. And so the point I would like to make on this chart is when this 40-week is broken, you can see that this MACD is very close to zero. And just looking back to the left on the chart, that's what happened in 2014, right when the oil market started to break down. We had a false alarm in 2013, but the dip in 2011 was pretty real below zero. So this chart says that, just be aware that the chart isn't exactly finding support where we'd like it to. Now, one of the things I want to cover off in depth is the US dollar, because it's at a real critical point. So first of all, this is the big picture going back 25 years. And what we see here is we're basically oscillating on the right-hand side here, but we're getting to a point where we've got higher highs and lower lows. And usually that's indecision. So with that indecision pattern, what we want to talk about is where are we going next. And one of the things that's obvious here on the bottom is that the momentum trend is broken. And I think I shared that when we had our August presentation. So a little bit concerned about how that's starting to play out. Now, I'll just move to the next chart. Here we have the US dollar, just the RSI, and you can see we got a bear market signal down here. And so we're currently expecting some sort of a bounce up into the 50 or 60 level and not much higher. So we're about 4 cents off the low. And if we got up to 96 or 97, that would still be fine. And so this bounce is taking place right now. The point I'd like to make is when we had a big bull market before in the US dollar, when it broke, it barely got above 50 for almost 2 years. And so these bounces all the way down were here. So we're at the point now where we are at the gut check time where we need to decide whether this market's actually going to break higher or roll right back over and continue going down. And I'm of the opinion with this bear market signal that lasted for almost 2 months that that's not really a signal that we usually see in a bull market. So I'm expecting the US dollar to roll over. There's a great quote by one of the gentlemen, expect the expected. And so I've aligned my thoughts with a US dollar going down based on this bear market signal. And whether or not I'm right, I guess is the question. But the point we want to watch for here is getting the let me just get rid of that banner, is getting this US dollar message right, because I think it's really going to be imperative. So what we see here, zooming in on the weekly, this is an 8-year chart, and this just shows the uptrend that we've had, and we're near, we're very near breaking this uptrend. And so that's one of the big things to be aware of. And if we look at the Japanese yen, we have sort of the same sort of chart kind of coming into play. So these are pretty important suggestions. And one thing that we did have is when the Japanese yen breaks, that's usually bullish for gold. So I'm watching that chart quite hard. And I've got that coming up right here. So what you see on this Japanese yen is a breakout to the upside would probably indicate that gold was going to start more of a bull market run. And you can see back here in 2011, 2012, when the yen topped, it was much like when gold topped. And then gold's kind of been consolidating for 4 or 5 years now. What we want to see is a breakout to the upside here in the yen, if we were expecting a breakout to the upside in the dollar. I will show down here with the PPO over a couple of years, it was always negative, and so that was a pretty good clue. But then we had a big push to the upside, and this is more like a wake-up call that perhaps the big bear market in the yen is ending. And now we've come back up, and we're just hovering right around the zero line. So I'm watching this pretty closely. Right now, we're trying to bounce off support. So in terms of a trade, I would suggest that now is the time to expect a move to the upside. And if we don't get the move, a tight stop would get us out of there. But if that move happens, I would also expect the gold to start improving. Okay, so here's the euro. And one of the things about the euro, of course, is we have this concept of support and resistance. And we broke through resistance, came up, pulled back down, and we're right at the place where we would expect to bounce back off and to head higher. You can see that we clearly have a big uptrend in momentum, and the same thing where we had this big bear market in the euro. The PPO had trouble getting to new heights. And so you see this, and this rollover is a pretty important place to be watchful of. And we've rolled right over now. And if it comes back and stays above zero and heads to the high side here, that would be very bullish for the yen, or for the euro. Now, the reason I think that actually might happen is I'm going to run down and just show you some of these charts from Europe. And the point on these charts, this looks very bullish. The Dax is in a big uptrend. This is a monthly chart. We have a little bit of divergence, negative divergence here. And on the PPO, we have this trend line that we're just coming up to touch here. So we have an uptrend and we have kind of a lid on the PPO. And what we're expecting is to watch for which way this breaks out. Now, the German market was trying to break to the upside here. But I want to show you the weekly chart and just give you an idea of what's going on here. We have a lower high on the PPO on a weekly. So the other chart was a monthly. This chart, we basically touched the RSI 70 and immediately reversed. And here we have an outside week on the DAX. And the big thing about the DAX is normally when the euro's getting weaker, the DAX gets stronger. And so what we have now is we have a situation where it looks like the euro's about to bounce off that support line I showed you. And here we have the DAX giving us a hard reversal signal. We have a much lower high on the PPO. So if this was to roll over here, this would be quite a divergence. And so, again, we're just mapping it out because we get to talk about this once a month. And the point I want to make is that we didn't hold. So we had a breakout here for 3 or 4 weeks. We just kind of toggled sideways. Then we ran up briefly, and now we've reversed it. So it looks to me like this is a failed breakout. But again, first week, let's just keep watching it. But we also had the same sort of major signal coming off a good strong run, and then the DAX gave us a big reversal candle. And then that was kind of the top going back into 2015. Just to remind, the HYG is also giving us this signal. So it's one of the reasons that I'm starting to wonder about that. Now, here's the Dax Daily. What you see this week was it sold off almost every day. And even as we get down here, now we're starting to watch really closely this 13,000 level. So I think it's kind of important. Now, the uptrend on the daily PPO has broken, but I'm not that big a fan of a daily PPO. The point here I will make is that the uptrend for the German market in terms of momentum, we broke that trend back in May, and now we've put in a lower high. I like it as long as these uptrends continue, and when they start to break, at least think about cautionary trades and stuff. And you can see here when this uptrend broke back in 2016 or 15, that was a good place to be aware of the trend change. So this week it rolled over a little bit. It could still accelerate higher, and we'd just keep watching. But at this point, I would say it's a huge cautionary week for us. Now, if I go to the CAC, the French market, the same thing happened, except it took 2 weeks for a reversal. This is a big thrust above resistance, basically a stalling pattern, and then failing and giving it all back. So this is a complete reversal as a failed breakout. And we see that we had the same momentum trend break in France as we did in Germany. And now we're rolling over and we're coming back down. And this market here is actually put in 2 weeks of kind of a rolling over motion on the PPO. So again, a little bit cautionary. And if you look at the RSI, same thing. So I'm not looking for trouble, but one thing that showed up when I went, I have a chart list called Market Summary. It's like 300 pages, so it's not summary. But the funny part about it is when I look through those charts, I was starting to notice a whole bunch of signs of caution. And so I'm just going to share these with you. So this is the big picture on the CAC going back into the monthly chart. And as you can see, there's a PPO line here that, if we can break out through the top side, very bullish. And on the other hand, we have this low slope on the PPO that we'd like to see hold again on monthly. But we have already broken the big 2009 uptrend on this first dotted line. So again, getting into semantics here, but the real question is, if this is a failed breakout, this is a pretty important place to watch, because 1 month after making the big picture breakout, if we rolled right back over, that would be concerning. So again, just lining up some flags here and starting to make them, just bring them to everybody's attention. This is the Swedish market, and the only reason I like the Swedish market is they kept the krona separate from the euro. And so one of the things I found when I was actually going through and marking charts every day was this Swedish market would break down before the other markets. And I didn't know why, but what you can see here is 2 weeks ago, this fell below this upsloping trend line on a daily. Again, a daily. So let's not get too concerned about it. But the main point would be that look at this RSI signal, first time in almost a year. This is below 40. So it does suggest perhaps there is a trend change, and the MACD is going back below zero here. So again, the Swedish market is more sensitive. It's smaller, easier to fall apart. It doesn't have as much support. So that concerns me. Now, just staying with the Swedish or with the European market for a little bit more, this is the Euro Top 100. So the top 100 stocks in Europe, much like the S&P 100. And what we see here was we were coming up here and we basically hit and made a double top on the big picture. And we have divergence on the RSI and on the PPO on a daily chart. So it's just another point that suggests caution. So the Euro 100, if it was going to roll over right here, this is an important place to watch. And again, the divergent high, and you can see the lower highs on the PPO as we come across to the right. So let me go back up and just cover off a few more here. Excuse me. This is Italy. And the problem on Italy is the Milan index here was trying to get through this major support resistance level. It was support in 2015 before the market really cracked. And we have this nice uptrend trying to hold. We briefly pushed up, and I could have drawn this line higher or lower. So let's not get too focused on that line. But this uptrend is in pretty important place. And again, we see the MACD just going to sleep over here, or the PPO. So if this is about to roll over, that's something that I would like to be aware of. Now, the second component of that is, let's just go look at the MIB on the, let me check that one more time. So this was the weekly chart, and now I'm going to go to the daily chart. My apologies there. Okay, so this is the uptrend, and it's very clear. It's really, really strong, but you can see we're right at support. We have negative divergence on the daily, and it just suggests more caution here. Now, Spain gets a little more interesting. And the reason Spain is more interesting, obviously, is with the Catalan separation vote and that kind of thing. There's a little bit more consternation in that market. So this is a weekly chart, and you can see we had a big uptrend going, much like the rest of Europe. We broke momentum in June, and now we're down here, and the MACD on a weekly is right, or the PPO is right near zero. We briefly tried to rally last week, and if you look at the candle, we rallied, gave it all back, and immediately rolled over and took out support for the last month. So I'm much more concerned that there is starting to be a broader sense of weakness. Now, of course, we have one other market in Europe that's pretty big and a little bit focused, and that is the FTSE. And so the point I want to make on the FTSE here is the MACD, or the PPO, is getting down near a very low level. We have slight, you can either call it a flat top or a slightly upsloping top, but we're right on this upward trend line here as well. And when we go look at the daily chart of Europe, and so I don't know what's going on that's making all these charts crack, but you can see that we clearly tried to break just above here and immediately rolled over and went to 1 month lows from a high. And so that, you know, from a 5 month high to a 1 month low in a week or 3 or 4 days is pretty radical, actually. And normally we don't see that kind of quick pullback, but there's clearly not a lot of support standing up here. And so we have negative divergence showing up on the weekly chart, sorry, on this daily chart. And we also have a PPO near zero on the weekly. So all of those things combined to give me a little pause is probably the right word to say for it. So again, I'm just going to go back and look at this HYG chart and examine it a little bit more and point out the reasons that I'm a little more cautious. When you look at the PPO as it goes below zero, so in 2011, this was also the Europe crisis in 2011, and HYG fell quite hard, and so did the US stock market. We had a reasonably big pullback there. In 2012, a brief glimpse below it, and it kept taking off to the upside. This is when we started QE Infinity. And so I would have expected this chart to really rock. Now, just to make sure everybody understands, there's an underscore here. So I've removed the yield that you would get from HYG. This is just the price, not total return, which would bring in the yield. In 2013, so everything is in a bull market, and yet the bond market issued some warnings in there. Anyway, clearly it was a false alarm, not much happening. But in 2014, it gave us a great signal that things were problematic in one area. That ended up being oil, which showed up. That actually marked the top in oil in June. And then in September, the actual oil market started to break support. And as it broke support, you can see this chart continued to unwind. Made its lows right down there with everything else, with oil, with the overall US market. And then we rallied out of that hole. In 2016, we had the election low, and then we bounced out of there. And now you can see that this week, HYG actually broke to 2 month lows and below the 40-week moving average. It's also very close to falling below zero. And if you go back and look again at 2014, when we went below zero, that was important. So I'm just saying the bond market's a little bit sensitive here with the HYG showing this signature. And so I really want to be aware that not everything is as rosy as we see. Now, on the other hand, if I go to Asia, Asia is absolutely flying and everything looks great. If I go to the commodity markets, most of them look pretty good. So I'm just going to spend about 5 more minutes here and jump into the commodity markets, because I think there's some great charts in there, but there's a reason that we need to also be focused. Here's the US dollar timeline from 1995 to 2002. It rallied up, and basically that timeline gave us a pretty good indication. So I've drawn the same timeline over here, and you could see from the 2011 low, you know, we're in about the range where we might have expected another break in a big bull market in the US dollar. So at this point, it's still too early to call, but we've got higher highs on this end and lower lows on this end. That instability suggests to me that we could definitely roll over. Now, we had that back in here, and we went on a big US dollar bull market run for another year and a half. So we have to watch. But again, using the RSI that we saw on one of the earlier charts, it doesn't look like the US dollar has enough strength to stay in a bull market based on that oversold level. And again, we get the matching pattern in the euro where it's trying to bounce off support. And it looks like we're seeing some of the European stock markets roll over or at least pause after trying to break through resistance. So that all sets up a picture to me to say caution. Now, on the commodity front, what we see here is the CRB is trying to rally up against this down-sloping 40-week moving average, or 40-month moving average, and we have a 10-month that it is above, so the 10-month would be equal to a 200-day. So we're above it, and we want to get through these prior resistance levels here. And if we can get through those resistance levels, that's a pretty important thing. Now, the major support level down here at 181.83 or 182 or 182.10, you can draw your line anywhere in here. The bottom line is we've actually closed above it last month and we continue to work above it this month. So the commodity market also suggests probably that the US dollar is getting ready to weaken. Now, if I go into the CRB, just the weekly chart, what you see here zoomed in is we're trying to get this RSI up into the 70 category. And if we got to the 70, that would be considered a new bull market. Now we can look to the left, and when it tagged that, it was fine, but it spent about 4 months up there and then immediately rolled over into a bear market. So it doesn't tell us how long of a bull market we might have. And our last touch was at 30, which says still in a bear market mode. So that's why I have this red line drawn up here. So as bullish as I am on commodities, this chart hasn't given us a big bull market buy signal yet. The MACD is moving above zero, and obviously, or the PPO, sorry, which is the same as the MACD. It's just done in percentages rather than using the actual price value. So the point I want to make here is that as this goes positive, this is a pretty bull signal. This is also turning up here, and this is a really nice place to get long the market. We've got a bullish cross on the moving averages. The 10-week has moved above the 40-week. You know, that's associated usually with a pretty good trade. So want to see that trend continue, but I'm starting to get a little worried that it needs a little time to relax and maybe just come back to support. Here's the DBC, which is supposed to track the commodities, and it's already broken out to new highs, unlike the CRB. So this chart suggests that we are in a new bull market, and we've got a bull market signal on this. Now, the scooter ranking, because it's an ETF, where CRB, we can't trade it. So this is something we can actually trade, and the scooter is up around 90. So we'll see if it can stay up there. But if we're going to get into a big bull market in commodities, this would be one of the charts to continue to watch. And look at the volume signature for the last 2 weeks. After having declining volume for most of the year, this thing absolutely rocked it with, you know, new 6-month highs in volume, price breakout to 2-year highs, which is what crude also did, but a bull market signal here and the scooter taking off to new highs. So it looks to me like commodities want to start turning. And if we have the agriculture fund, this one's really interesting because it's been a dog that just doesn't hunt. And what we see is there was a support level here in the black line. We fell through it, and now we're trying to rally above it. And we're also trying to rally above this big downtrend line. If this was going to start to break, that would be very, very bullish. And we haven't seen that yet. So I don't like the fact that the RSI got down near 30. I don't like the fact that the SCTR ranking is at 10. And the PPO recently broke this big uptrend line and fell down hard. So that's a big problem for us. And I don't know any other way to deal with that. But this uptrend line, if we can get past the end of this pennant, if you will, and just see if this was kind of like selling out the last of the bear market and rallying above, because you do get, in commodities, you end up getting a final thrust usually, where the market breaks down and then rolls back up. So that is starting to show for me, and it's one of the things I'd like to pay attention to. I just want to briefly, if Tom will give me 2 more minutes here, I just want to show that copper, which I think is obviously one of the most exciting metals with all of the electrification going on around electric cars and everything is right at a major horizontal support and resistance level. And I've specifically left this volume. The question is, what would we like this volume to do? And as we see it breaking out here, we want to see more breakout. And the problem is, if I just delete it, what you see is the volume is really declining hard in the last couple of months here. So this suggests we might need a little pullback to the 40-week before we have enough momentum to get going, because there's not a lot of buyers showing up for work here as this tries to make new highs. So anyway, so that's a big component. Now, briefly, oil, obviously, I'm bullish on, but it has had quite a run. So I'm just going to quickly go into gold, and then I'll pass the torch to Tom here. Gold had a $12 down day on Friday, and this is the GDX Gold Miners ETF. And what we see here is the moving averages are, basically flat, 2340, 2305, prices at 2250. So we're trading tightly in a zone on this weekly chart, and we're looking for a breakout to the upside. Now, we had a bull market signal here, and we stayed above 30 here. So it could potentially be in a bull market, but this is the weakest bull market we've seen in a while. But look at this volume signature, and we just saw this on agriculture, where it was breaking out. So what I'm looking for, on the DBC, what I'm looking for is, if we start to see a volume pop on GDX, that's probably going to be a big clue for us, either with one of these final lows, much like that agriculture one, or we actually start to get an upturn and we break out to the upside here. And that would probably follow on with the yen breaking to the upside and the US dollar breaking to the downside. So I'm not bullish on gold yet, but I'm watching it literally every day. And the last thing I'd like to point out is that these rare earth metals are really on fire. And we pointed this out back in July and August when we did this market outlook. But this thing has been taking off to the upside. So it was 1750 back then. It's 2750, and it made new highs this week. So this continues to look like a bull market. So let's focus on where the bull markets are. But this rare earth metals appears to be on fire, and that's probably lithium and cobalt and other metals that are being used in the electrification of the cars. So with that, Tom, I'll turn it over to you, and you can show them what you've got.
All right, sounds good. Great presentation there, Greg. I'm going to stick mostly here in the U.S. Actually, I think everything I look at here today will be in the U.S. But first, I just wanted to start off with the S&P 500. I think it's pretty obvious to most everyone that we're still in the midst of a very strong bull market. And so for me, bull market rules apply, which means I'm not looking to short. I'm going to stay on the long side, and I'm going to use pullbacks as opportunities to better my reward to risk on individual trades. So what I want to do today is just kind of go through and show you some of the areas of the market that I think are worth considering here over the next couple of months. It could be that they're worth considering today, or some of these areas may just be worth considering as we get pullbacks to some key support levels. But here on the S&P 500, as we move higher, this rally that we've seen over the past couple of years looks very similar to the big move that we made up off of the 2012 lows all the way through the middle of 2015. So we went about 3 years there, went sideways, consolidated for about a year, and now we're back off and running again and continuing to move higher in this bull market. So I am going to continue to view this as a bull market and trade as such. A couple of things to keep in mind, though, as we go through. First, looking at the 10-year Treasury yield. One thing that you have to remember is that when the Treasury yield is rising, money is coming out of bonds. So anytime that we've got the yield on the move to the upside means money's coming out of bonds, because it's lower Treasury prices that drive the yields higher. So when money's coming out of bonds, the question is, where does it go? And if the yield is rising, it's normally a sign that the market is anticipating economic strength ahead. So when that yield is moving to the upside and money is coming out of bonds, many times it finds its way into the stock market. And if you look here, the yield bottomed back in early September, made a huge run up. And if we pull up the S&P 500, during that same time frame. Actually, it started a little bit earlier in the middle part of August, but we have had a huge run as these treasury yields have been moving higher. So just keep that in mind as well, because the Fed keeps talking about additional rate hikes. We did just recently break out. If I go back to that 10-year treasury yield, we had a 240 to 242 yield that really served as a major overhead resistance area for the yield up until about 2 or 3 weeks ago when we finally cleared it. And after pulling back, we held on to the most recent low, and now we're starting to move. It looks to me like this downtrend that was in play for about a week and a half, 2 weeks, has ended pretty solidly with this yield jump on Friday. So if we get another leg up in the yield, again, that means money is rotating away from the bond market, and that is normally a bullish sign for equities. So keep that in mind. One of the areas of the market that I really like to keep a close eye on is consumer discretionary, and there's a couple of reasons for that. Number one, anytime that you've got the S&P 500 moving higher, it tends to indicate that we're seeing strength, higher earnings, and so forth in the weeks, months ahead, because the market is a leading indicator. It's always looking down the road. With consumer stocks, though, I think that they give really good signals because 2/3 of our GDP is from consumer spending. So how consumer stocks perform, in my opinion, is very important in the whole scheme of things as far as whether or not a move to the upside in the overall indices is sustainable or not. And when you take a look here at the consumer discretionary group, we had topped back in June, and you can see a few other attempts to break above that early June high. Couldn't do it, held on to support on the bottom. So we had an uptrend and sideways consolidation, which is a bullish continuation pattern. And we just recently got the breakout on the XLY above this triple top. And notice the pullbacks recently have come down and held on to the rising 20-day moving average, which I find to be very bullish. And we closed yesterday right near the high, if not at the high, that we've seen over the past couple of weeks. And this is despite weakness that we saw last week in the S&P 500. So all of a sudden, we're starting to see a little bit of leadership from the consumer discretionary space. And that hasn't happened in a while. We've struggled in consumer discretionary mostly because of retail stocks. But nonetheless, on a relative basis, that has not been where we've seen the strength. But we have had a couple solid days on retail last week toward the end of the week, and we did see the group as a whole bounce. So I think that this is pretty significant. On the other hand, and the second reason why I really think that consumer discretionary is important, because I want to see that group outperform consumer staples. Because when you're going into consumer stocks, you have two choices. You can go into the companies that produce and provide us with the things that we want, or you can get into the thing, you can invest in the companies that provide us the things that we need. And those are two different things. And depending on where we are in the economic cycle, it really matters as to which way investors are turning with respect to consumer stocks. So here you're looking at consumer discretionary breaking out to a 2017 high. And now I'm going to show you the XLP, which just recently broke to about an 8-9 month low. It has come storming back, which is actually a good thing because we want wide participation in a bull market. So I'm glad that that breakdown didn't hold. But I think you can see the difference between what's been going on with discretionary stocks versus what's been going on with staple stocks. We still have quite a ways to go here to get a breakout on the consumer staples area. So traders are still turning to those companies that provide what we want and not just what we need. And I think that's really important because when money is flowing in that direction, that tends to indicate that folks feel pretty good about their job. They feel good about the economy. That's when you tend to spend money on those discretionary items. So I like what's taking place in these areas. I can keep moving on here, and let's take a look at the banks versus the S&P 500. Now, on this chart, you see some sideways action. You might think, well, banks aren't performing very well. Well, banks are never leaders, or rarely. Rarely do they take the bull by the horns and take off to the upside and lead the market. What you really want is just a healthy banking sector. I audited banks when I was in public accounting, and I can tell you, as long as the economy's good and banks are able to loan money without having to, significantly increase their loan loss reserves and so forth, as long as that credit is available, then I mean, that's really what drives U.S. stocks. The fact that, if you want to expand, you can go to a bank, you can get a loan, you can expand, you can hire employees, you can do all the things that helps drive our economy and the market higher. The problem is when banks start to underperform the market, they get very conservative. Most bankers are very conservative. And so if they start losing money on their loans, they will restrict lending, and their money instead will go into much safer investments like Federal Home Loan Bank loans, or something that carries much less in terms of return, but also they don't have to deal with all the risk that loans carry. So it's important to watch banks. And I think what we're seeing here is just that banks are going along for the ride with the S&P 500. And if we look at the same chart on a weekly basis, you'll see that we actually had a huge run up in the second half of 2016 into early 2017, meaning that banks were really wildly outperforming the S&P 500, which is somewhat unusual when you look at the last 5 years. And now they're just, again, going along for the ride. So I think banks are still a good investment, but I don't expect them to be leaders. If you're looking to really capture the essence of a bull market, the big returns, probably not going to get them in the banks, even though they did have a great second half of 2016. All right, let's keep rolling along here. Now, here's the beauty of a bull market: wide participation, rotation. That's what keeps a bull market alive. It's like when one group or area tends to move lower, the money simply rotates into another area because there are technical buy signals in so many different areas of the market. So when one gets a little overbought, starts to pull back, the sellers decide to take it a little bit lower. That's, if you're in a bear market, that money doesn't go anywhere. So you simply are just taking one leg at a time to the downside. But in a bull market, anytime we see weakness in some areas, that money tends to rotate into other areas. Looking at the XLI and the XLF, the financial sector, the last highs on the daily chart, check out this MACD, which was going lower. So we had a negative divergence. We failed to hold the 20-day. We failed to hold price support. And we just worked our way all the way back down to the 50-day moving average. And the MACD has moved down to centerline support. This is what I call a MACD reset. When you have slowing price momentum, and then you follow that up with the inability to hold a breakout, I look for the 50-day test and the MACD centerline test. And so we've gotten both of those on industrials. I would not be surprised to see industrials begin to work their way higher again in time. Now, there is still, if we look at price support, I guess there's the possibility we could see another couple percent to the downside to hit this price support level, and maybe this trend line that comes across that probably coincides with that price support. But I also would not be surprised at all to see a bounce from the 50-day moving average. So my point is, industrials are starting to look better based on the fact that we've seen this pullback. Notice how overbought we were on the XLI. It needed a break. The group needed some rest. We've gotten that. Now the RSI is back down into the 40 area, which during an uptrend, you can see as you look across, most lows coincide with an RSI reading in the 40s, 40 to 50 area. That's where you're going to see it during most of these major lows. So I think the XLI is actually starting to set up much better here. Taking a look at the financials, same thing. Higher prices, lower MACD, negative divergence, overbought, and now look at it. We've pulled back all the way back down close to the low that we saw in the second week of October, very close to the 50-day, heading down close to the center line, and now we've got the RSI down at 42. So again, while a lot of folks that don't follow technical analysis may just simply jump on board as prices are going higher, I think those astute technicians that wait, I think generally are benefited by lower prices. And here the XLF has pulled back. So, I think these groups which needed a break have gotten it. And while money has rotated away from those groups, technology certainly has benefited. We've continued to see technology moving higher. How about energy? After the downtrend in energy, there's not really a group that looks any stronger right now than energy based on this breakout of this downtrend pullback. Once again, overbought. We dropped down into the 40s. This is acting much more bullishly. Look at the volume trends as well. So I think we're starting to see a lot more interest in energy. Watch this rising 20-day moving average as we continue to move higher. And now I want to move into a couple of the areas or industry groups that are worth considering. Now, before I talk about this one, because this has been straight down, and I normally don't like a group like this, But I will say this, over the last 20 years, 79.4% of all S&P 500 gains have been earned in the fourth quarter of the year. 79, almost 80% of the yearly gains have occurred in the last quarter. So when you get into this bullish period of the year, it's hard for me to get bearish. In fact, I did an analysis and I went back 66 years on the S&P 500. And from October 28th to January 19th, the S&P 500 had been higher 57 of the last 66 years. So this is not the time of the year historically for the market to pull back. Now, it could pull back anytime, and I know these are just numbers, and yes, the odds are greater that it goes higher, but certainly a pullback could occur. I'm not trying to provide anyone a guarantee. I'm just stating facts. 79.4% of the S&P 500 gains have been earned in the fourth quarter. 62.2% of NASDAQ gains have been earned in the fourth quarter over the last 20 years. That's a pretty significant historical tailwind to keep in mind as we wrap up the end of this year. Now, among the strong performers during November and December, tires is one of those. And you can see it got off to a pretty rough start here in November after gapping down at the end of October. But it is, looks like maybe trying to put in a rounded bottom. Nice little candle on Friday. I just pointed out, not because I love it technically, but because this is the time of the year when the tire index tends to roll. 83.6% of their gains, their annual gains, they normally see in November and December. That's been their average over the past 20 years. So tire index is certainly one to consider. And when I talk about tires, you think of Goodyear tire, you think of Cooper tire, which is CTB. And you can see they've been struggling. But after this last gap down in Cooper, it's already come back up into this gap resistance zone, starting to strengthen here in November, like the overall group tends to do. Next up, steel. Steel earns 72.9% of its annual gains in November and December. And here we just got a 50-day test. We actually started seeing some strength in October, and this pullback now has just tested the 50-day moving average, MACD getting close to the center line. So I think steel's kind of interesting. And when you think steel, at least when I think steel, I think USX. USX is worth watching because this breakdown that occurred below support at about the 28 area, you can see that has really been the area where USX has struggled. So if we get a big volume move through $28, $29, I think this could be an indication of a run into the end of the year for X. Next up is the Homebuilding Group. And I know you might think, well, rates are moving higher. You don't want to be in home builders. I don't think that's the case at all, because I think when rates were low, the economy was struggling. No one wanted to buy a home. Now that rates are starting to move up, keep in mind they're moving up off of historic lows. Interest rates are still extremely low when we think back in history. So I think as the economy starts to show signs of life and starts to pick up, with interest rates still down in very low areas, I actually think it's encouraging folks to, hey, rates are starting to rise. I better go out and get that home that I've been putting off. And I think you're seeing that in the home builder space. Let me see if I meant to bring that chart up. I'm sorry. But right here, you can see the huge move here over the last month and a half, 2 months. Look at the volume coming into the home construction index. This is obviously a lot of accumulation is taking place here, and home builders earn over 50%, almost 53% of their annual gains come in the months of November and December, which may be somewhat shocking if you think about it. You might think that springtime is when home construction would really accelerate. But from a price perspective, when to invest, actually November and December are pretty bullish months. A couple of stocks in this space, and I've mentioned these before. DR Horton, DHI. I think this chart is absolutely phenomenal. But look at those blue mountains down here, just way overbought. I've got to see a pullback before I'd be interested. But this is a stock technically that I think looks great. Lennar, I think, is a little bit more palatable because we had so much consolidation and then broke out. And you can see a lot of volume on this pullback, but we didn't give away price support. And now we've rallied right back up on increasing volume to set new highs. So I think Lennar looks good. And then a smaller one, you may or may not be aware of, William Lyon Homes. I think this one, after sideways consolidation and this flagpole, straight up, heavy volume, I think we're consolidating. If we get a 20-day test, I think that one looks pretty interesting as well. All right, now a few of my other favorites, just looking at some of the charts, because some of these have pulled back. And again, what I look for in a bull market is I try to get healthy groups that have pulled back near a support level. So here you've got building materials and fixtures, which looked great, moving up and broke that trend line. But this is a group that moved from 810 to 920, or probably about 13 or 14% in a little more than 2 months. That type of rally is unsustainable. You can't rise 11, 12% in a group like this every 2 months. It needed a break. It's gotten it. It also, on the most recent high here, you can see lower MACD, negative divergence. We just got down to the 50-day, and we're about to reset the MACD. So I think this is an interesting group to consider. Aluminum, the DJUSAL. Another one. Look at the negative divergences here as it kept moving higher and higher. That MACD just kept dropping further and further. And now we're finally seeing the selling on aluminum. So I'd like to see this one bottom out. It may have been on the weekly chart that I was looking at. Yeah, on the weekly chart, notice it's coming right down to its 20-week moving average. After a huge move and a breakout, this is where I would expect it to turn. Possibly the prior high, which comes in just below 130. But this has now moved down from over 160 into the 130s, probably about 14 or 15% pullback in just the last 2 or 3 weeks. I think this could be setting this group up for a move to the upside. Let's see. Next up was, I think it was the Waste and Disposal Services Index, another group that just recently broke out. And I think this was on Waste Management's report, which was awesome. And we've since seen a pullback to test the area where it gapped up. I think that is pretty interesting. And if you look at Waste Management, which helped to create this breakout, it's actually moved up and has done almost no selling. So you got a beautiful bull flag here on Waste Management. So I think this is one within the group that looks pretty interesting. Another one that maybe you're not as familiar with, CWST, which is Casella Waste. Another big breakout here. And this one has pulled back very close to price support around 19. So I think this is an interesting chart. Let's keep going. We've got home improvement. So home improvement had a negative divergence. Notice the breakout here. Higher prices, lower MACD, and came down. We failed to hold the breakout, failed to hold the 20-day, and now we're consolidating between both the 20-day and the 50-day. And this is one that looks kind of interesting to me, looking for a move to the upside. I think a break back up above that 20-day moving average would be very interesting. A couple of stocks here, maybe a couple you're not aware of, but BMCH, which is BMC Stock Holdings. Notice that after gapping down back in May, we really struggled to get through 22.5. We just did that yesterday, and look at the volume picking up. So I think BMCH is an interesting play. Home Depot, you probably have heard of them. Let's see if I can get that chart up. Home Depot, higher prices, lower MACD, negative divergence. We've now gotten the 50-day test, and MACD is getting close to center line. Notice we were overbought on a couple of occasions. Now we've got that RSI down close to 50, then dipping down into the 40s. So I think Home Depot looks interesting. And I don't know if Greg remembers, but back in January when we started this whole outlook thing, I actually picked renewable energy stocks as my #1 industry group for 2017. And I'm not really somebody to forecast long term. I was just looking at it thinking that maybe energy prices would move higher. And usually when energy moves up, oil prices start moving up, you start getting more interest in renewable energy stocks. And here you can see the recent breakout after sideways consolidation, but it's been a huge run up for the renewable energy stocks. And what's interesting here is when you look at the price of crude oil, just recently at the end of October, as it made the breakout to multi-month highs, and then eventually to take out 2.5-year highs, getting through $55 a barrel. This has all occurred here in just the last 2 weeks. And again, if I go back to that renewable energy chart, look what's happened with renewable energy. So as all of a sudden crude oil comes into the limelight, rising, you see a lot more interest in renewable energy stocks. So in this group, I know First Solar, sometimes that's categorized as a semiconductor stock, but I still think of it as solar stock. Here you can see this is really the one that's leading the whole group. Big breakout on heavy volume. That was following a very solid earnings report. And so First Solar continues to move higher here. The last group that I had that I wanted to talk about was the gambling stocks. And I think gambling stocks look really good. They sideways consolidated off of an uptrend, actually equal highs coming across, higher lows. So you have an ascending triangle, and we just made the breakout. So this is part of that consumer discretionary area. I think this could be a real leader throughout the balance of the fourth quarter. Their fourth quarter results historically are not bad. Their best months tend to be March and April, though. But still not bad this time of year. A few stocks in this group worth thinking about. It's SGMS, which is Scientific Games. Made a huge breakout back in July, but it's continued to move higher. A couple others I'll give you in this space. First, ERI. You may be familiar with this one, may not. Dorado Resorts. This one just recently made a nice breakout with heavy volume. I don't know if that's earnings related. My guess is that it probably is, based on the fact that we had a similar move back at the early part of August. So it looks like that both of those moves were earnings related. But ERI looks good. And of course, probably the one that I like the best in the group is Wynn Resorts, which does take its time, consolidates, and just continues to move up. And it just recently broke out with some pretty solid volume here in the past couple of weeks. So those are some ideas. Now, specifically looking at individual stocks, I'm going to go through these really quickly. But these are all companies that beat top line, beat bottom line, and either changed the character of their charts and became more bullish, or were already have been bullish and just continue to trade higher. But the first one is Akamai. Now, Akamai had been in a downtrend, but recently with solid earnings, gaps up. Notice it comes back to gap support, the rising 20-day moving average, and then it turns back up again. I think this is really starting to behave much more bullishly. I will also point out that if you look at the seasonality on Akamai and then drag this back for the past, however long it goes, 19 years, check out October averages going up 10%. November averages going up 15.5%. That's not an annualized return. That is telling us that during the month of November, Akamai averages going up 15.5% during November for the past 19 years. So when you consider that and then look at this fact that we just turned out of a downtrend, I think Akamai is one that really you want to pay attention to. FLIR, FLIR, and I didn't mean to do it with seasonality. Let's just look at the charts. FLIR, great volume coming in on this move. I just have to see at least a 20-day test, something. I need to pull back. It's just overbought. So perhaps we're getting that now. General Motors went through a huge move back in September and October. Great volume. Recently pulled back. This is actually one that I do own. This one pulled back, hit the 50-day moving average, and I'm looking for a move off of that. ILMN. Hold on one second. Oops, I got the wrong chart list up there. All right, so ILMN, that's not what I want. Well, let's just pull this chart up. ILMN off the breakout. Now, this is one of the biotechs, and biotechs have pulled back quite a bit. I still like the group longer term, but it's definitely pulled back. This one really hasn't pulled back much, and I think is setting up in a very bullish ascending triangle. A breakout above 215 would measure up to 235. So this is one I definitely am keeping on my radar. JNJ, I did buy this one. Yesterday went down below the 20-day, took out recent lows, but managed to come back in, print a hammer right on the 20-day moving average after a solid move up with earnings and heavy volume. Just a few more here. LII. Lennox. Beautiful move up, very heavy volume, pulled back. I literally just bought this one yesterday on the 20-day test. Polaris, I own this one. This one I got on the 20-day test, getting close to this gap support area. This is kind of how I trade. I like these earnings-related gaps with heavy volume, especially ones that continue moving up, because when everybody wants to buy at the open, that's when you have market makers on the other side of the trade providing liquidity. And normally market makers make money. So what that normally means is gaps fill. When you see a gap and then it continues going higher, that's a pretty good sign that there is major accumulation taken and a lot of demand. So if you sit back and wait, let it pull back, a lot of times you can get these at some pretty interesting levels. So PII, this one looks pretty good to me. LVS I mentioned earlier. I can show you, this is where I had that little comment. See that little tail that came down on Thursday? It was during the show, during Market Watchers Live, and I had a stop in at 66.86. It hit 66.85. But I still love the stock. And actually, if it pulls back to about 65 and a half or so, get down close to that 20-day moving average, I would be a buyer. 3M, I'm trying to give a bunch of good, different size stocks. So J&J is obviously a big company. GM, 3M here. This is another one that gapped up. I don't own this one, but I do like this pullback to the rising 20-day moving average. PCH, this is Potlatch Corp. Big gap up after earnings, but then put in that bearish engulfing candle. So I was waiting for a pullback here. It actually did get the pullback. I'd like it more on another test of the recent lows at the 50-day moving average. I don't own this one, but continuing to see the volume picked up yesterday and a continuing move to the upside on Monday may send this one right back up to $56. The three more, Skechers, SKX. I think this is a great looking chart. Huge gap up. Notice come back down. Gaps top of gap support, 20-day moving average, and then it starts to rebound on Friday. Unfortunately, I didn't get into this one. And two more, VFC. Another one, earnings related, gap up, pull back, hit that 20-day, and move back to the upside. And one thing I think you can probably see between Greg's analysis and my analysis, I tend to take a much shorter term look, and I definitely trade very short term. But the final one here, CarMax. Actually, if we can get back to this, the top of gap support, that was a huge volume bar, nice candle. So 71 or so, or 71 and a half would really be interesting to me on CarMax. So with that, I'm going to go ahead and wrap up. I know I went a little bit over there, Greg, but I don't know if we have questions. What do we got?
There was a couple in there, NSC and RSG.
Individual stocks.
Yeah, NSE. So I think it's the Nifty in India.
Oh, that's the bank. It's not the bank one that they're looking for, right?
No, I don't think so. You might just be, if you just go to dollar Nifty, I think works. Yeah.
There we go. Well, I like the sideways consolidation off the uptrend and the recent breakout, retest, another move higher. I'm still seeing most of the major indices around the world very bullishly. I'm seeing them in bullish light until I start to see major breakdowns. So I actually like the group, or this particular index. I like this pullback test of the 20. I would expect you're going to have another challenge of the recent highs in the near term.
Okay. And what about RSG?
RSG, Republic Services, well, big gap down on heavy volume, and then we continue. I mean, this is going to be a really important low down here that I would not want to see violated. So I'm going to say 62 and a half is going to be an area that I'm going to watch really closely. If we break below that, another big volume bar or something, that's just starting to show me that the uptrend may have ended, and we're starting to move back to the downside. Now, because we're in a bull market, I'm going to make bull market assumptions that we're going to hold on to this recent low and that we're eventually going to go back up and take out that high. But I would definitely be aware of this support area. And if it gave way, I would not hesitate to get out, put my money to work somewhere else.
Okay, and there was a brief question about the Canadian bank. So maybe you could put up xfn.to.
All right.
And this is the capped financials index in Canada. And obviously, you can see we had a nice run off the September lows. And just rolling over now, it wouldn't be uncommon for it to gather a little, to have a bit of a pullback here. It's testing the 20-day right now. The one thing I wonder is just the high yield chart seems to indicate that there might be a little bit more difference in the perspective around the high yield. So I don't know if you get a test of 37. I did hold a couple of Canadian financials, and I had chandelier stops in, and I got taken out on yesterday's close. So at this point, I'm out of them. It's not that I didn't like them; it was a nice run, but I have left them. So.
Well, that's what the chandelier exit does. It takes you out of positions, mechanically, so you don't sit there and think, well, give it one more day. I'll give it one more day. And before you know it, you start losing your gain. So I think very structured way of making sure you capture your profits.
Yeah, it worked out well, actually. It was a good trade. So, and with that, Tom, we should probably wrap up. We're running past the end of the hour here, and appreciate you taking the time. Hopefully, we've given some oversight into some of the things that we're checking out for the next month, and we'll be back with you in December with another round of market outlook. Thanks, everybody.
Yeah, and I do also want to just comment real quickly, just make sure everybody's aware that Market Watchers Live is now going 5 days a week, so Monday through Friday from 12 noon to 1:30 p.m. Eastern Standard Time. Greg does come on the show periodically, and Greg, you're going to actually be joining me this Thursday and going to be doing some work with point and figure charts. So if point and figure is something that you're familiar with or maybe want to become more familiar with, you want to make sure you join us on Thursday for Greg's visit. But we have very interesting guests throughout the week. Greg Morris is going to be joining the show on Wednesday. Greg's been a technical analyst for over 40 years. He has his own blog here at Stock Charts. And I always like to pick everyone's brain that comes on just to see what they're thinking about the current state of the market and where they see it going down the road. So Wednesday will be really interesting. And then Erin Swenlin is actually going to be doing her she's going to be doing chart patterns on Friday. So if you'd like to hear how she views the chart patterns, how she recognizes them, what they mean, calculating measurements, targets, and that sort of thing, you'll want to join our show on Friday for that. So anyhow, definitely check out Market Watchers Live if you haven't already. Love to see you in there on Monday. And as Greg pointed out, we'll be back second Saturday of December for our next Stock Charts Outlook live webinar. Everybody have a great rest of your weekend, and hopefully see you on Monday. Take care.
And thanks to all the veterans out there for their contributions. Thanks, everybody.